So I think we'll get started. So welcome participants to our regularly scheduled Thursday afternoon Innovative Business Advisors webinar. We're going to get started fairly quickly here today. We have a lot to share with you. So I just want to go through a few things logistically. We're conducting the webinar on the Zoom portal. You'll notice at the bottom of your Zoom portal that there is a Q&A button. If during this webinar you want to pose questions to the panel, type your question in the Q&A portal, in the Q&A dialogue, and we will make sure, I will monitor that dialogue and make sure that your questions are answered. As a matter of fact, I will interject during the conversation and the presentation to make sure we get your questions answered. So today's webinar, we have a quick update from Steve. We did have some activity relative to CARES Act and federal guidance, banking guidance around the COVID programs that are available to us as businesses. So a quick update from Steve on that. And then our panel will begin, and we have 4 members on the panel today. Steve, as you know, Julie Pumphrey, you've met before. Julie is one of the principals of Innovative Business Advisors. And joining us is Julie's dad, Ron Hoddes, who Steve will introduce later, Sage in Our Business. So with that said, Steve, I'm going to turn it over to you. And if you'll go ahead and give us an update, and then you can introduce Ron, and let's get started.
Outstanding. Marquita, and as always, we're very appreciative of you giving us your Thursday afternoon to moderate these panels. So folks, welcome to Thursday, November 5th. And as of today, I don't think we know yet who our next president's going to be, but hopefully it won't be too much longer before some certainty comes back into the executive branch. There are a couple of updates to share with you before we dive into what I'm sure will be a very interesting discussion today. So first and foremost, the Small Business Administration released a new document for those PPP, the Paycheck Protection Program borrowers that received loan amounts of $2 million or more. The SBA is now requiring a loan necessity questionnaire be filed along with any forgiveness application. So I'm sure your banks were going to be forwarding those documents to you in the very near future. You know, for those faithful attendees of our webinar, we do our best to keep you up to speed on any new changes. And that is the most recent addition that's come out. One other quick addition that I would make is that, and we've talked about the Main Street Lending Portal many times on this webinar. So the Main Street Lending Platform is a loan program for small and medium-sized businesses throughout the United States that's administered by the Federal Reserve, specifically the Boston branch of the Federal Reserve. That loan amount minimum was $250,000. It's been reduced to $100,000. So if you are a business owner that could still benefit from very inexpensive lending at this point in time, we strongly encourage you to go out and take a look at that program. And if you have any questions, we have all the details and we're happy to forward that as well. So with that, our audience is well aware of the fact that we're living in a very interesting times, as the old saying goes. There are certainly lots of businesses that have faced a lot of distress. A lot of individuals have faced a lot of distress as a result of this pandemic. And the banking system has certainly faced a lot of distress as it's had to adjust to some of the new PPP loans and other various lending programs that are out there. And that has definitely had an impact for business owners. So today we've got a very special guest. I affectionately refer to him as one of the key founding fathers of the business broker industry. If there were a Mount Rushmore of business brokerage, Ron Hoddes would definitely be on the mountain. Mr. Hoddes has been involved in business brokerage for many, many years. He is considered one of the foremost experts, not just in the US, but worldwide. We are honored to have him today. Incidentally, kind of a little insider secret, he's also Julie's dad. So you can begin to understand how blessed Innovative is to have such an amazing lady on the team, and then obviously access to her dad, who's a real giant in our industry. So Ron has agreed to join us today and talk about the specific situation we find ourselves in, and specifically how seller financing can be a real benefit to sellers in these really unusual times. So Ron, we strongly welcome you to the program. It's a delight to have you today.
Thank you.
Very excited about your information and your willingness to come on and share that with our audience. And without further comment, I'm going to turn it over to you. And I understand Julie's going to move the program for us.
Okay. Today we're going to talk about seller financing for a few minutes. And in my experience, I would say that probably more than 90% of the deals that we sold were seller financed. And it was a pretty common way to sell a business. I just talked to some of my old people last week, and one of the old brokers that worked for me for like 20 years, he was telling me that probably during that time period, 98% of his businesses he sold were seller financed. So that's how high the percentage is for seller financing. And done right, seller financing makes a lot of sense. So we'll go through that here now. So, Julie. Okay. So how is a sale of business financed? All cash to the buyer. That's not very common. Okay. And the most common thing is a down payment with the balance financed. And the down payment is normally equal to the seller's earnings. So if the business is making, say, $250,000 a year, the down payment is equal to $250,000 a year. And the balance is financed by either a bank or by the seller, or a combination of the two. Bank financing can be straight with the bank. Can you back up for a second, Julie?
Sorry.
Okay, bank finance can be straight with the bank, okay, if the seller or the buyer has enough assets to pledge as collateral, or you get an SBA guaranteed bank loan, or a combination of SBA financing and seller financing. Most SBA loans require a small amount of seller financing. So number A3 there is probably the most common method of bank financing. And then number B there, 100% seller financing is a dominant way to finance a sale of a business. Now, Julie. So the reason we can't get all cash from a buyer is if the buyer had all cash to buy a business, a broker would sell them a larger business, making more money. For example, if a business is priced at $300,000 and the earnings are $150,000, and the buyer had $300,000 cash to invest, we would sell them a business making $300,000. Why would they want to buy a business making $150,000 when they could purchase a business making $300,000 a year? And on the flip side, why would a broker want to make a commission of $30,000 on a $300,000 business when they can make a commission of $100,000 on $1 million business? So that's why we can't get all cash from a buyer. Next slide. Banks prefer collateral, and businesses are mostly goodwill. And as we all know, goodwill cannot be repossessed if the business fails. So to assist with business acquisition financing, the federal government's created a loan guarantee program through the Small Business Administration. It's called an SBA loan. And typically the SBA guarantees 75% of the amount loaned by the bank. So the bank still puts about 25% up. So the SBA loan is partial federal government money and partial bank money. So the bank is involved. A lot of people don't understand that. Julie? This is just a chart that we've used over the years to talk about SBA financing and the matrix you need to get an SBA loan. And this was a company called Eagle Capital in California that did SBA financing. And you need about 19, 20 points to get an SBA loan. And if you go through this quadrant here, you'll see that, for example, with cash flow, to get 5 points, you need to have debt service coverage of 1.5 or better for the last 3 years. That's not real common, okay? To get 3 points, you need 125 or better for the last 3 years. And then to get 1 point, you need 1 or better for the last year plus an interim. So as you can see here, it's hard to get a lot of points. Collateral, you need 125% or greater to get 5 points. Okay, you need 75% to get 3 points. You need 50% to get 2 points. Management, you need 3 years of recent experience owning and running a profitable small business in the same industry. Well, typically you don't see that. 3 years recent experience owning and running a profitable small business. Even that's not real common. Minimum of 3 years recent experience managing a profitable business in the same industry or related industry. You don't see that. 2 or more years of management experience. That's what we see most often. As you can see here, as we go through this chart here, it's hard to get a lot of points. Okay, credit, clean credit. Normally a FICO of 700 or more is not a problem. So normally on credit, we get 5 points. Everybody has a FICO of 700 or more. It's rare we see a FICO less than 700. If we do, it's in the 6s, and that normally gets you 4 points. So credit is normally not a problem. Down payment, okay. Loan to purchase price, not to exceed 60% with non-borrowed cash. 35% or greater. 30% or greater for 4 points. 20% greater for 3 points. So normally we do about anywhere from 15 to 20 points, okay? And so here again, you can see it's hard to get points. So the bottom line here is when you go through this chart, you can see it's difficult to get enough points to get an SBA loan. So the SBA loans are not easy.
Ron, it's kind of interesting in our market too, the debt service coverage ratio. Most lenders at this point in time don't like to go below 1.25 at all. So yes, unless there's very high scores in the other areas, they just won't even talk about that. And I'd also like to ask you to expand a little bit on the management side, because I know buyers, particularly if they're coming out of a corporate environment where, you know, somebody might say to you, well, look, I've run a $50 million company, or I ran a $100 million company as part of a global organization. How come I'm getting such a low score in that area? Can you speak to that?
Well, that's a variable, okay? It depends on the kind of business you're buying, okay? If you've been running a $10 million business and you're buying a $1 million restaurant and it's a completely different industry, that's hard to get a loan. If you're in the same industry or a similar industry, for example, if you were president of a manufacturing company and you're buying a smaller manufacturing company, then the bank will give you a little more latitude. So it's kind of a function of what's your management experience, what industry it was in, and then what kind of business you're buying.
So
yeah,
Ron,
and the key to that is it's not just the money. It's they do have to have relevant experience. Without that at all, it can become very difficult to get any kind of loan.
That's exactly right.
Yeah. Hey, Ron, let's stay on this chart for a minute because I have some questions for you. You know that well, Ron, you don't know this, but I'll share with you. My background is as a banker. So when I see a chart like this, it gets me real excited. And certainly in the role I was in, I had overriding exceptions for underwriting. And I look at this, and the question I'm going to ask you is this a formula that's used for general guidelines and underwriting? And when we look at the bottom and we see the marginal to excellent ratings, is there a make don't make kind of a you pass the test at one number or another, or is it and I know this is for this particular firm, Eagle, and their decision-making process, but I just wanted to get a little bit better insight into how this fits into that underwriting decision to go or no go on a specific deal.
It's not black and white. That's the bottom line. Just like Steve was talking about there. Okay. If you've been doing something and you're buying a business completely different, okay, they're going to want a higher score. Okay. If you're coming out of a business that's virtually identical to the business you're buying, then they'll work with a slightly smaller score. So they're a little bit flexible on that. The bank is. That answer your question?
To a degree, because you're referencing the management column specifically. I'm looking at the overall score, where it considers all 5 indicators, and at the bottom you have the ranges of 10 to 13 marginal, 12 to 16 fair, 17 to 20 good, 21 to 25 excellent. Would we expect a company to be in that 21 to 25 range to get a go or a consideration, or what would be kind of a cutoff when you look at the overall?
I will tell you that 21 to 25 is not very common. Okay. I would say that 17 to 20 is more common. But I've also seen banks accept a loan about 15 or 16 points. So it depends a lot on the person and the business. Okay. It depends on the cash flow. If the cash flow has been constant, that helps a lot. Okay. If the cash flow has been a bump, that's not as good. Okay. So the cash flow has a big impact. The collateral is very important. Okay. A lot of small businesses that we sell have a lot of goodwill. Okay. And they don't contain a lot of collateral. And so that's one of the reasons why it's hard to get the collateral, because a lot of businesses don't have a lot of collateral. Okay. And it's not uncommon to see, goodwill get above 50% in small businesses.
So Ron, this is excellent as an overview for folks about how banks typically make lending decisions, if you will. How does this apply to the owner? Are they using similar information when they come to a decision about providing financing?
No, they never see this chart.
Okay.
We show this chart to the buyer just so the buyer understands why getting an SBA loan is difficult.
Got it. Thank you.
Any other questions?
I'm good so far. Excellent. Thank you very much.
Okay, Julie. So let's talk about seller financing loan package. Okay. When you go to the bank, you need to have a loan package. And here's a typical loan package. Okay. You need to have a table of contents. You need to have a purchase agreement and copies with the escrow documents. You need an overview of the business profile, the literature, an executive summary on the business. Okay. You need to have financials on the business, a year-to-date balance sheet, a P&L, accounts receivable aging report, a list of assets, liquidation value, an asset schedule allocation, a debt schedule, 3 years of P&L, 3 years of balance sheets, and 3 years of federal tax returns. You need an org chart, and you need a payroll detail, including tenure of the employees. Section 5, you need copies of any long-term customer contracts. Section 6, they want to see the lease. Section 7, a covenant not to compete, and a training agreement, okay, with the seller. They want to see the buyer's resume and the personal financial statement of the buyer. They want to see the buyer's credit report and proof of his deposit, okay. They want to see the buyer's tax return for the last 3 years. So here again, a lot of buyers don't realize they're going to have to show their tax returns, okay. They want to see a buyer and seller disclosure statement and an executed IRS 4506. And then they want to see the buyer's business plan. And this is where a lot of buyers get kind of sloppy. So what happens is, if you don't have all 11 of these items, when you request a loan, they put the loan package into an inbox, and it goes to the bottom, and it works its way to the top. And if they go through there and they find that part of section 4 is not there, guess what? They hand it back to you, the broker, okay? And you have to start all over and go back to the bottom. So sometimes it takes 2 and 3 weeks just to get this thing to the top of the inbox. So it's important that when you do use a bank financing, that you put together a very good loan package. and it takes a lot of time to put together a good package. And a lot of people don't understand that. A lot of brokers don't understand that. Any questions on that one?
Well, I'd say the other thing that, particularly if you're going after SBA financing right now, this is outstanding. The other thing that they're now requiring is they want to see detailed month by months during this pandemic period.
Yes.
And you've got to provide some cash flow projections based on what's happening as well. So the underwriting process is not getting easier, it's getting harder.
Yes. And the COVID has hurt it.
Yes, it's having an impact, no doubt.
Okay, now let's talk about seller financing. Seller financing is very difficult to understand and appreciate. Initially, most sellers do not want to finance the buyer. They want all cash. Once they realize they can't get all cash, when they start to understand seller financing, they kind of like it more. Given the difficulty in obtaining SBA loans, especially in this economy, okay, like you talked about there, let's talk about the advantages to a seller finance. Okay, one, it gives you a quicker close. Okay, two, typically the seller can get a little higher price for the business when he does the financing. It avoids a large income tax hit. Okay, the seller gets a good return on his money. Most sellers, a lot of businesses we sell are retirements, and typically a lot of sellers don't need the money. Okay, and so they take the money and invest it. Okay, where's the best place to invest your money? In a business that you know, okay, and you get a higher return on your money because you can charge a higher interest. You get a nice monthly check. Okay, every month you get a check, and a lot of sellers love to retire, get a check every month. It ensures the future of the company because the seller has limited control, and we'll talk more about that in just a minute. But due to the fact that the seller is doing the financing, the seller is going to ask for monthly reports, okay, inventory levels, employee levels, questions about the customers and so on. And he wants to see this every month, okay? So this more or less forces the buyer to pay attention. A lot of times when a buyer buys a business, he gets so inundated by the business, he doesn't pay attention to the finances. And this kind of forces the buyer to pay attention to finances when he first takes over the business. And it's also nice for the buyer to have the seller involved a little bit because now he's got somebody to ask questions if something goes wrong or if there's a problem, okay? It ensures the employees' jobs. Many times in companies we sell, a lot of those employees are like family, okay? And they've been with the company for 10, 15, 20 years. And the last possibility is sometimes it's nice to have lifestyle benefits. What some sellers want to do is say, well, why don't you lease me a car, okay, for the next 15 years, a new car every 3 years or something like that, you know. So you can also get lifestyle benefits out of seller financing. The bottom line is seller financing, when you get into it, really makes a lot of sense. Okay. And sometimes we don't think about all different ways to do seller financing. The most common is a secured note. But you can do earn-out payments, okay? And we used to, when I was in the business, we did a lot of earn-out payments, okay? And that's where the business is increasing, okay? And the seller wants a percentage of the sales. And so instead of getting $1 million for the business, he's getting an unknown amount of money for the business, but he's taking a percentage of each month's sales, okay? The buyer can assume some seller guaranteed credit. Many times when a seller sells a business, he's got credit with the bank, and the buyer can take that credit over, okay? He can take a note on capital equipment, okay? Many times in like manufacturing companies, there may be some manufactured equipment that has a note on it, okay, for the equipment. He can take that note over. Or on the flip side, if the owner owns the equipment, what he can do, he can lease that equipment to the buyer. So they can have a lease on the equipment to the buyer as a way to finance. Sometimes a business that contains a lot of inventory you can consign the inventory, okay, and pay for it as it's consumed. You can have a non-compete agreement, okay. You can have a lifestyle agreement. You're gonna give the buyer's gonna give the seller health insurance, life insurance, car insurance, or whatever, okay. Some businesses, the seller can sell a license. So if the seller's got something that's kind of unique, he may sell a license for his business, and they can get their seller financing through a license. Sometimes the seller will charge a sales commission. He gets a percentage of her sale. There can be an employment agreement. Sometimes the seller doesn't want to completely retire 100%, so he might like to work once in a while, 10 hours a week or whatever. So you can have an employment agreement with a very high salary. You can have a severance agreement, okay? You can have a closing bonus. And sometimes the severance agreement and the closing bonus go with the employment agreement. So I'll get $10,000 a month for 3 years, and then there'll be a $25,000 or $50,000 severance agreement, and then there'll be a $100,000 closing bonus. So that's one way you can push the down payment out, okay? You can have a lease on seller real estate. If the seller owns the property, you can lease the property to the buyer at a higher rate, okay? Many times the seller may have family members involved in the company, okay? So you can ask for some kind of security for the family members, or you can ask for higher wages for the family members. Most landlords will want the seller to stay on the lease anyway, so you can get a fee for that, okay? And you can also get a fee for guaranteeing the lease. I know when I sold my business in California, I had to guarantee the lease. And then also, the buyer can pay a royalty for the product if it's got a product involved. So those are the different kinds of seller financing you can look at. And a lot of people don't realize all the different types of seller financing you can use. So any questions on that? Okay. So let's get down into some details here.
So Ron, this is Marquita. I'll just interject because I privately answered a question. Again, there was another question on whether or not the slide deck would be available, and the answer is yes. I want everyone to know that we will provide a copy of the slide deck. You're getting substantial compliments on the content of your presentation.
Okay. Yeah, we can hand the slides out. Nothing confidential here. So the financing choices are: number one, bank financing with an SBA guarantee with or without a seller note. Like I said, most SBA guarantees require a seller note, a small one. Okay. Typically, it requires additional collateral from the buyer. Most banks will want the buyer's house. Okay. When a buyer tells his wife that he's put the house up for collateral, she's not happy. And many times she won't let that happen. Okay. If the buyer gets into trouble and misses payments, the bank shuts down the business and forecloses. It's black and white, okay? Where a seller is not quite so black and white, okay? The lifelong employees are laid off, and many of those employees are like relatives to the seller. The lifelong creditors don't get paid. And again, many of those creditors are the seller's personal friends, okay? The customers can no longer get goods or services. And again, many of those sellers' customers are good personal friends, okay? The business is closed and the seller's legacy is gone forever, okay? The bank has an auction. The auction proceeds don't begin to cover the bank note, okay? And the business is gone and the seller's note is worth nothing, okay? Choice number two is seller financing. It starts out with the seller only paying tax on the down payment and not on the note amount. The seller gets a good return on his or her money and a nice monthly income. The seller is protected because of our right to offset language and our monthly reports that we put in our notes, okay? If the buyer starts to get into trouble, the seller already knows because of the monthly reports, okay? Together they solve the problems. Maybe the buyer misses a payment or two, but the seller is going to be forgiving. He's going to know what's going on, and he's going to work with the buyer And if there's a couple of notes payments that are missed, they can work that out and they can deal with it. Okay. So the seller is a lot more flexible than a bank is on missed payments. Okay. Together they solve the problem. The business continues. The buyer's down payment is safe. The seller's note is safe. The employees' jobs are safe. The creditors are safe. And the clients continue to get goods and services. So as though there's two choices with financing, bank financing or seller financing. As you can see here, seller financing makes a lot of sense.
Ron, there's a particular dynamic in the marketplace where sellers, as they get older, tend to take their foot off the gas a little bit in the business, right?
Right.
And we call it internally in our firm, we call it the glider path, right? Where the owner just begins to kind of cruise for a while.
Right.
And as we all know, as the business begins to cruise and slow down, they're really diminishing the value of the company pretty rapidly. But as I'm listening to your presentation, I'm sitting here thinking, this is seller financing is an ideal situation for that type of environment, because the sellers really, their dream is, and their view is, that somebody can take this and put their shoulder into it, if you will, and really get this thing back to where it was again, humming, right?
Right.
And in that situation, I think in many regards, the seller might like to take advantage of the business getting back to where it was, and seller financing provides a way for them to do that and provide a realistic set of financial constraints for the buyer to operate the business and return it to optimum profitability. And
in very few situations, we've actually had the seller take the business back.
Yeah, Ron,
so would you say that's that's kind of a worst case scenario for a seller? That's probably, would you say happens at the same rate as a bank foreclosure, or less often because the seller's more involved, or what's your experience in that regard?
I would say it's less often because the seller's involved in the business with the seller finance. So I'd say it's less often.
So seller finance.
I was in the business for over 20 years. Probably only 3 or 4 times did this ever happen. It's not real common.
Ron, one other thing too that I'm picking up here, and I don't want to get ahead if you're going to cover this in the presentation, but as you went through the prior slide, one of the thoughts that came to mind for me is that depending on the seller's tax situation, some of those alternatives that you had included there in the seller financing alternatives could make a huge difference in taxing when the tax occurs, and what is considered taxable and under what structure it would be taxable. I thought that was really interesting because you had so many options in the structure of a seller finance deal.
And right now, if Joe Biden wins, okay, and some of the taxes he's talked about, that could have a major impact on the seller. So if Biden gets in, there's a higher probability seller financing will be more common for that exact reason. Any other questions?
No, let's move forward. Yeah, let's move forward. Good.
Here's just a graphical presentation to show you an example, a little easier to understand. So choice number 1 with bank financing, we've got a business that we sold for $1.4 million with an SDE of $400,000. The buyer puts down $400,000 and finances $1 million with an SBA lender. Okay, so the SBA note is for 10 years at 7.25% interest. The payments are $11,740 a month, or $140,881 a year. That leaves the owner $259,000. The seller gets $1.4 million cash, less his closing costs. That's a lot of money. And like you just talked about, that's a lot of taxes. Okay. The buyer pays taxes on that $1.4 million, less any cost basis of the company. But a lot of companies are older and they don't have a lot of cost significance. Okay. They depreciate everything down to 0. So they have to pay tax on a lot of the $1.4 million, okay, typically. So that's looking at it from an SBA loan, okay? The next slide, Julie. Here is the seller financing. The same business, same price, same SDE. The buyer puts $400,000 down and finances $1 million with the seller, okay? The seller gives a little less interest in the bank, 6% for 10 years, but he's getting 6% on his money. His payments are $11,000 a month, $11,102. That's $133,000 a year. That leaves the owner a few more dollars, okay? But it gives the seller a nice income, okay? The seller receives $400,000 cash, less the closing cost. So tax implications are a lot less, okay? It gives them a nice monthly income of $11,102 for the next 10 years, okay? Plus, one thing a lot of people don't think about, okay, now the seller is getting $1,732,000 for the business, and it spreads his taxes over 10 years. So he's getting $332,000 more because of the interest on the note. And the next slide kind of summarizes that. And there you can see, choice number one, the seller gets $1.4 million cash, okay? And the implications of the buyer are about the same. Okay, choice number two, okay, the seller is getting $1,732,000 for the business, plus he gets that monthly check, okay? So the seller gets almost 24% more for his business than if he didn't take seller financing. Now, what a lot of sellers like to do, they like to brag to their buddies what they sold their business for. So that 24% gives that seller a lot of bragging rights. He can say, I sold my business for $1.7 million, okay? And you're laughing, but that happens.
Mhm.
Okay, any questions?
I'm laughing because it's true.
Yeah.
That's why I'm laughing.
So in today's world of buyers concerned about the economy and making long-term commitments, seller financing demonstrates seller confidence in the business and its ability to make money. And that's important to a buyer. Next slide. So how's a seller protected if he or she takes a note? And next slide. Right to offset. Okay. The seller is protected by using the language we have in our paperwork. Okay. And we have a right to offset. And one of the most common things is things come up after the close of the sale. Okay. It happens probably 50% of the time. Okay. And what happens is the buyer will stop making payments. Okay. And so we have a right to offset language where if there's a problem, okay, the buyer keeps making payments every month, but the seller and the buyer walk through the problem and understand it. Okay. And that's how we solve any offsets. Okay. And many times the seller will say, oh, you're right. You know, I should have paid that off or done this or done that. A lot of times what will happen, the seller will forget about something. Okay. And it'll pop up after the close. And so they'll settle that and things will move on. So the right to offset language gives the buyer protection, and it also gives the seller protection so the buyer doesn't do something stupid. Okay, any questions about that? It's important you have that language in there, and this is the actual language right here. Okay, next slide. And notes are non-negotiable. And the reason they have to be non-negotiable, it protects the seller from a tax liability. If a note is negotiable, okay, that's considered constructive receipt. Okay, and in the eyes of the government, if you've got constructive receipt, that's the same thing as getting cash. Okay, and you have to pay cash and pay taxes on the whole amount. So all the notes are non-negotiable for that reason. Any questions about that? Next slide. So in summary, seller financing is often misunderstood. seller finance makes a lot of economic sense, and done properly, seller financing really works. And it's been very successful at selling businesses. And it's a win-win situation for both buyer and seller. Both people come out better. Any questions about anything?
Yeah, so it's you were saying, Ron, you've used that a lot in your experience. You mentioned earlier at the start of this discussion that you've done probably 90% of your transactions or more in that regard over the course of your career, and you're a real innovator in that and created a lot of these things over time. For sellers that are worried about the future economic environment, right? Typically, one of the things their investment advisors are always telling them is take the cash now, right? And we can put it into safe investments into to protect your future needs, right? How would you deal with that objection?
That's pretty easy because, what would you rather put your money into? A business that you know and trust, or an unknown business? Okay. And most people prefer their own business, especially due to the fact that we have in the note, we have provisions where he gets to see what's going on every month. And so he has a little inside information how the business is doing. And if he sees something going wrong, he can step in there and help solve the problem.
Yeah, and I think particularly a lot of things that sellers may not appreciate is that buyers are going to have that reporting requirement, whether they use a bank or the seller. So, banks are becoming more stringent about providing financial documentation on a regular recurring basis while the note is in process. And as you mentioned earlier, if they miss a payment or two because of some temporary distress in the business, bank starts to send in the workout department. And, a lot of those guys are named Guido, and they're not a lot of fun to work with.
If you'd like an example, I can give you a good example.
Please do. Yeah, a short story or case study would be excellent.
Many years ago, I sold a business. It was a manufacturing business, okay, and we had a recession hit, okay, and what they did, the business it took. And it made wiring harnesses, okay? And it sold wiring harnesses to manufacturers. So it was basically a wiring harness manufacturing business. And what happened, the recession hit and the business just dropped off. And the seller found this out because of the monthly note, okay? And so the seller had moved out of state, and he came back and he had an RV, and he put his RV in the backyard of the business, and the seller and the buyer started working out a solution for the problem. And what they came up with was a solution where what the buyer was going to do, in addition to making just a wiring harness, he was going to assemble the wiring harnesses under the parts. So he was going to add more value to the process. And what happened was that worked out very well. And the business shot back up again. And so the seller missed a few months' payments, but the buyer was able to make that up pretty quickly. And the business actually was a better business at the end of that than it was beforehand. And that's how they got through a recession. And in today's business climate with this COVID, that's something to think about for a seller.
Yeah, and recessions happen. It's a normal course of the business cycle.
Right.
So definitely happens. And who knows how long this environment we're in is going to last. We certainly didn't think we'd be sitting here 7 months from now still talking about it.
Right.
Yeah, Ron, let me ask you another question. And I'm thinking about the added eventualities in terms of the kinds of agreements that might need to be in place above and beyond just simply the a basic seller financing financial agreement, so to speak. And what I'm thinking about is the scenarios, and I just want to hear your experience in the work that you've done in the past. Are there incremental documents regarding what if the seller dies what is transferability of that agreement? How is the family protected? How are others protected in a situation like that? What if the buyer dies? Who is the seller interacting with in a scenario like that? Have you had any kind of incremental agreements attached to simply the financial agreement around the seller financing regarding eventuality, especially in one that would go over a longer period of time, you know, where the actual payout occurs over a longer period of time?
Yeah, to answer that question, the one thing that I did do that most people don't do is we wrote the note ourselves, okay? And we sit down and wrote the note, and Julie cut my presentation down. It was originally about, what, 60, 70 pages long, Julie? So I had a lot of it.
Yeah, he had the notes and the due diligence and the whole closing process. And I was worried about timeliness. Dad, I did pull up the slide, though, one of them about the reports, if you wanted to show that.
Okay.
So, but you can go ahead and you want me to pull that slide up about the note? I can pull that slide up as well.
I don't know how we're doing time-wise and question-wise, so.
Yeah, we're doing great. We got about 12 minutes left in our allotted time slot.
Yeah.
Okay, I will find the note and pull that one up. So keep talking while I look, please.
Okay. Well, when because we write the notes, you can put anything you want in the notes, okay? And you can add all kinds of things. You can talk about the business, okay? Most sellers want at least a P&L every month, okay? You put that in the note, okay? And that's just as important as the payment, okay? A lot of sellers want to see the inventory levels. A lot of sellers in a business that does bigger things may want to see who the customer was, okay, for that particular month. And so you can write all kinds of things in the note, okay? And what I had as an example, I don't know if Julie's gonna pull this up or not, but I had a lot of different customer notes that we wrote into the wording in the notes. And
yeah, I can pull that up. I was looking for the other one and I'm having trouble finding it, but let me share this one.
There's a supplement to the note there. It says other changes.
There you go.
So here's an example, like to be included with each month's payment shall be a copy of the previous month's profit loss statement, a copy of the previous month's ending inventory. If the inventory drops below $40,000, Mr. Buyer will meet with Mr. Seller to explain why the inventory is declined. If the inventory drops below $25,000, this note becomes immediately due and payable. Okay. Other language we use. To be included with each month's payment shall be a list of the employee headcount. To be included with each month's payment shall be a copy of the order backlog. This particular business, the seller wanted to see the backlog. That business had a large backlog all the time, okay? To be included with each month's payment shall be a copy of the number of orders filled with the customer's names and dollar amounts. So this is the kind of language you can put into the note when you write the note yourself. So we always wrote the notes.
And that would, I assume, Ron, that's in conjunction with the seller, because the seller knows what the key performance indicators are for that business.
Exactly. The seller makes a determination here.
Yeah. Very wise.
A taxi cab company, and we put in there that we were going to have a report every month on how many taxis were on the road, because the seller knew that the number of cabs on the road impacted the revenues. So that was what we used for that one.
Excellent.
And also, this makes the seller more comfortable with taking a note. Okay.
So from a tax perspective, right? So, you know, with, as you said earlier in the presentation, with accelerated depreciation, you know, most of the cost basis is gone a lot these days. So we're seeing situations where it's primarily goodwill. In the note scenario, they're going to be taxed on the at a capital gains rate based on the on the principal value of the note, and then taxed basically at I'm assuming a you know, the same kind of dividend rate, if you will, for the interest. Is that correct?
Well, you saw there my example, that example of $1.4 million.
Yeah.
Okay. If the SBA loan's involved, okay, then the seller has to pay tax on $1,400,000. And that capital gains tax is a big number. Okay?
Yeah, particularly with the Obamacare surcharge.
Right, exactly. And so that's one of the main advantages to seller financing is the taxes, because the taxes are much, much better. Okay. And you pay less taxes when you have smaller amount of money than when you have a lot of money.
And these notes are inheritable, to get back to Marquita's
Yeah.
question as well, right?
Yes, they are.
Yeah, excellent.
There's a sample note there. Okay, this is the one that had that $40,000 and $25,000 inventory in it. So this is the actual note.
Yeah, I'm assuming in this situation, the seller knew that the working capital and inventory levels were really important for the health of the business. So
Right.
they put some special provisions in there.
Mm-hmm. And it's hard to see it here, but here's a lot of the small language here about offsets and things like that. Okay. And you can put in here things like if the seller's in poor health, for example, and he doesn't think he's going to live 10 years, you may put a paragraph in there about the fact that it goes to the wife if something happens to the seller. We've done that. Okay. So you can put provisions for things like that in there also.
You know, it's interesting. You talked about lifestyle provisions as well, and I don't have a lot of experience with seller notes, so this is relatively new to me, and that's a very interesting thing. I'd never even considered that in my thought process. So, was that something that you used pretty routinely?
It wasn't real common. We use the most common thing was health insurance.
Yeah, and
because health insurance stays lower because it's a continuous program.
Mm-hmm.
So when the buyer buys the business, the seller's health insurance is already part of the business expense, and you just keep that in there. So, but yeah, there's a lot of pluses to seller financing.
Yeah, not to undersell the bragging rights that you talked about earlier as well, right? The ability to talk about the premium.
Okay, we have a few comments have come in, and I'd like to share with you Stephen's comment. He says taxes are not always capital gains rate. Recapture of depreciation and other items can be taxed at ordinary income tax rate in year of sale, even if there is a note, different than an S Corp or a C Corp. Okay, so
yeah,
he's
we didn't talk
I'm
about
assuming,
S Corps versus C Corps.
Yeah.
A C Corp is a lot more difficult because you've got the company. The company has higher tax rates with a C Corp versus an S Corp.
Yeah. I'm guessing, Steve, and you might put a comment out there, Steve, who sent the note. Are you a CPA? I think he's just simply making a point for us.
No, I'm an engineer.
Yes, Steve is a CPA. So
Okay.
yeah. And I think this is an interesting point to make too, because a lot of what you're talking about here, Ron, and one of the things that I personally use as a practice, and I'd like you to speak to it, and that is making sure we've got the right team and the full team, and that is the right people who are tax experts and the right people who are legal experts in the process. And while I realize you have many of these documents, you might speak to that. How do you work with other professionals in the process when you use these predefined boilerplate documents, if you will, and you are actually coaching the seller on the kinds of terms they may want to put in a seller note?
Well, sometimes we get the seller CPA involved. Okay. I'd say probably more than half the time for that exact reason. Because the CPA, by going through the taxes, that helps with the seller understanding the benefits to seller financing. And one thing one thing that happens also, you don't think about this, but I had a situation, for example, one time where 1/3 of the CPA's business was the seller. And if the seller had taken an SBA note, okay, that CPA would have lost 1/3 of his business, okay, because the buyer had a CPA. By keeping the seller involved, the CPA continued to stay involved to a lesser degree, but he didn't lose as much money.
Yeah, and sometimes that can have unintended consequences, as we've all seen before. So that was a pretty elegant solution.
Yeah.
Yeah. Well,
okay,
excellent.
so we're getting to 3:57, so we've got about 3 minutes left until the top of the hour. So I think we might start to wind up a little bit now. Steve, do you want to start the wind up process for us?
Yeah, absolutely. So Ron, thank you very much. Incredibly informative hour, and we very much appreciate your time and wisdom and sharing that not only with us, but also with our audience. So hats off to you.
Okay. I enjoyed it.
Well, we're very, very grateful, and thank you for agreeing to share your slides as well, your wisdom with the broader audience. I've just put up our resources slide. Everybody's seen this on a weekly basis. I just remind you that we've got multiple resources as well. You can always find us at innovativeba.com. And a second book in our series, You Don't Know What You Don't Know, will be released in the next month or so. So you can go to youdon'tknowyoudonttknow.com and learn more about that as well. So again, Ron, thank you very much for your wisdom and time today. Marquita, as always, your stewardship is amazing. And Julie, thank you for coming on and introducing us to your dad and shepherding us through the presentation today.
Okay, thank you.
Yes, Ron and Julie both. Thank you so much. Great webinar today. Very informative.
Okay. Okay, bye.
All right, have
Bye.
a great day, everybody. We'll talk to you again next week. Take care.
Bye.